All right, guys. Welcome back. Welcome back. Happy New Month and welcome to the month of love. Welcome to February and welcome back to ValeTalks. And as always, I am your host, Innocent Rion Iferi, and I have with me my amazing guests and speakers today on the live. But before we get started, I just want to bring us quickly into information, even though it's coming a bit later, but I believe that most of us might have and must have heard about the Jacklot Global Trading Contest currently happening on ValeTalks. On Valetax, we are currently having a trading competition where every lot traded boosts the price pool by 10 USD, and every 500 traded lot boosts the price pool by 1,000 USD. And what is the Jacklot trading contest? It's all about showing your skill in trading and trading up to a certain amount of traded lot size and making sure you also maintain good trading and risk strategy in order for you to win this prize. And what are the prize pool? We see that first place is taking about 13% of the prize pool. The second place takes 15% of the prize pool. Third place takes 10% of the prize pool, and fourth place takes 5%. And the remaining 20% of the prize pool goes to the fifth place to 20th place on the Jacklot trading contest. As you can see, currently the prize pool is up 44,950 USD. The moment another 500 lots is traded, it goes up by another 1,000 USD. So just imagine what it would look like and it would feel like if first place is going on with 30% of over 50,000 USD. And I'm sure by the time you do your maths, you know what that is. And this is how you get into the contest. The contest has started and is going to be ending on the 6th of February. It lasted for 12 days. A minimum lots traded is one lot. Account types are the standard and booster account. Minimum balance in order to enter this trading contest is 100 USD, and the winning condition is basically how many lots traded that you have. In order for you to get registered, all you have to do is log into your dashboard in your member area, as you can see, and type in your password. Type in your password, go to your member area, sign in. And when you're done signing in, you need to come to promotion. You need to come to contest. When you come to contest, you see the active contest going on, which is the Jacklot contest. You open details to read more about it. And it tells you everything you need to know about the contest. And then all you can simply do is join. You can see how much first place is making, second place, and what their reward currently is. First place reward is about 13,500 USD, which is 30% of the total prize pool of 45,000, just recently updated. So all you have to do is join this account by opening an account type and deposit the money, and you get started. Thank you.
And
this is all you need to know about the Jacklot.
How much fine? How much do you have to put in minimum?
100 USD minimum.
Wow.
So just put in
only 100 and you can make 44,000. That's pretty good.
Yeah. So that is how to get into the Jacklot contest. And for the key events for today, ValeTalks. So on this week's ValeTalks, we're going to be looking at how global events impact the market, causes and effects. And I'm so happy because the topic itself just resonates with the motto for ValeTalk, which is talks that power your next move. And when we talk about global events in the market, we're talking about events that actually power every move in the market, starting from macro events to major events to economic and socio-political events as a whole. These are the core reasons to why the market move isn't just technical or chart basis. Okay. So with me today, I have my guest, Manesh Patel and Shifu Kaza. If this is the first time you're watching us, be it from anywhere or any part of the world that you're from, if you're watching on YouTube, Facebook, Instagram, or you're connected via any other platform, Manesh is a global market strategist and educator. He's an engineer, CMT and CFT verified and certified with over 25 years of experience in trading. He's traded institutionally, he's traded as a retail trader. He's also developed the black box system for institutional firms that they use in trading. And he is the author of Trading with Ichimoku Clouds. And to the other side of my screen, we have Shifu Kaza, who is the global head of education at Valetax. As a veteran trader with over 11 years of experience and the author of Navigating the Economic World in Forex. And he holds a doctorate in major economics and providing structure and academically grounded guidance to traders globally. Thank you so much, Manesh. Thank you so much, Kaza, for joining me on this week's episode of ValeTalks. It's always a pleasure to have you guys because we'll start talking and we start discussing. And I just realized that the market is so wide that you can't know everything, and having to hear from different perspectives and experiences just kind of opens you up to more understanding. So personally for me, even if nobody was attending, was choosing not to stream Valor Talks, I would pay to stream you guys because I always learn a lot. So thank you guys for joining so much.
Good to be with you.
Thank you.
Yeah, and I'm Ryan Ifere, senior market analyst and for the African region at Valetax. Sadly, I haven't changed this for. I was doing a couple of calculations the other day and I realized that I've just done way over 7 years of experience when it comes to the foreign exchange market. And I like to count myself as one of those traders that likes to trade sentiment. And I like to help people gain clarity through the market, managing their psychology and their risk. And I also am the founder of the Rion FX Swing Trading Academy. So thank you guys once more for joining. And I hope you stay tuned. If this is the first time you're watching us on YouTube, don't forget to like, share, subscribe, and also connect to your friends and trading communities to also come in and experience and also gain knowledge from this event today. Moving forward for today, here is an overview of how it is going to be today during the ballot talk. So first of all, we're going to try to understand the cause. What exactly is the cause of global markets or global events that shift the market? What are the things that create this impact? Secondly, we're going to look at the effects. What are the effects that these events have? And thirdly, we're then going to talk about the trader's job, because the events happen on their own and they are not created by the trader, but the trader also has a role to play in order for him to keep himself safe, because the market is an anarchy and it's filled with chaos. It's only the disciplined who survive. So you need to know what your job is and what role you play in such situations. Thank you again once more, Manesh and Kaza, for joining me today. Before we get started, I just want to give a quick definition to the audience about what global events are. Okay, so when we talk about global events or we talk about fundamentals, a lot of times people think high impact news. But really, what we're really talking about is we're talking about global events which are political or socioeconomic. So global events are political, economic, or geopolitical development that influences risk perception, capital flow, and investor behavior, causing markets to reprice assets rapidly or gradually. Hence why a very good example is in terms of, political wars, economic wars. If you're here and you have no experience or you're new to trading, as at 2016 all the way to about 2023, if not so, there was a period where we were, having a lot of U.S. Sino wars, which was basically an economic war between China trade and U.S. So those kind of global events shift market and either bring certainty or uncertainty into the market depending on the assets. So one thing I need you to know today is markets don't react to news, and it's not every high impact news that actually moves or shifts the market. Yes, they bring liquidity and volatility into the market, but not necessarily shift the market. Global events are responsible for creating those shifts in perception of pricing. So thank you guys, and I will be moving to the first guest on the call today, who is Manesh, of course. I always like to start with Manesh. I and Kaza like to see him as big brother, so we always like to give him the floor first. Yeah. So, Manesh, what would you say are like the major causes, okay, of global events, and how do they really change their expectations? And when global events happen, do they happen to the economy as a whole? Does it affect the economy directly, or the effects or the causes of those global events now becomes a thing of interest for the economic bodies of the country?
Right. There's a lot to cover here. First, why does all this matter? Well, if you think about it, we're traders. In order to create a market, you have to have the buyers and sellers. And the
Yeah.
global events, no matter what they are, social events actually causes trends. And that's
Yeah.
what matters to us as traders, because we should be trend trading, not trading consolidation patterns where you're going back and forth. So a lot of these global events or social events causes trends, and that's really what matters. I'm not a fundamental guy, I'm a technical guy, but from the fundamental side, it causes people to react and start putting money in the market. So I look at the reactions of all the fundamentals and social events, and I look for trends. Interest rate decisions are big. On the U.S. side, Trump announced the new Federal Reserve, um, you know, banker that has to be approved. But that affected dollars, right? You had the Iran war, everything going in Iran. That affected crypto, believe it or not. Initially when Trump got involved with Iran, Bitcoin went up. Now Iran's coming to the table to negotiate, Bitcoin's going down. So you have all these events globally, which will affect prices of gold, silver, uh, currencies, the dollar, yen prices, and everything around the world. So everything now is highlighted even more because with the internet, you hear all this information very fast. So you have people now reacting to all these global events a lot faster now than what used to be. So you have a lot of volatility there and it starts trends.
Kaza?
Yes. Oh, it is the first time that Manish answered with a short answer. Usually, we will have a long answer.
I guess we pushed him too far into a zone he doesn't like to be.
No, I want to go trade that contest. Today's the first time I'm hearing about that contest, and I'm like, 44,000. I want to get off the call, go to the contest.
Okay, guys. So basically, the cause we are talking about, the cause of the market movement or the global event that changed the expectation of traders. The core of every major market move is actually a shift in expectation, right? Market do not move because of data release or speeches alone. They move because they believe about the future change, right? So for a long time, market might believe that growth will remain strong, inflation will remain controlled, or maybe policy will remain supportive. This belief actually became embedded into the price that we are having every day. But when a global event challenged one of those beliefs, the market must reprice. So actually a good way to understand is to think of the price as a contrast between, like Manesh said, buyers and sellers. Is based on their expectation of the buyer and expectation of the seller, right? So when those expectations break, the contrast has to be rewritten. And rewriting process is what we see as a volatility, trends and correction on the chart. So I think the cause is this is why the prices often start moving before the story is fully clear. A lot of the times we see the market move before or after the news, right? Suddenly, maybe 5 minutes or 10 minutes or 15 minutes before the news, the market is already made a move. Why? It's because of the expectation that they have that the global events that will happen at that time will make change to the market. So they will move first before the market has made decision, right? So this is what we call expectation shift between the buyer and seller. So uh, the market doesn't wait for the perfect information. So suddenly, Powell or now I don't, who is the new chairman of the Fed? I don't remember the new name. So let's
Kevin
say,
Walker.
yeah, let's say he make an announcement or whatsoever. Actually, the we call it a price in, right? So if the NFP data, PMI, CPI, whatsoever data is already priced in the market, so the traders or the investors will always make assumption of that price in price, so they will follow the course and change expectation based on the situation of the market. So I think it will always adjust as soon as the probability of a different futures increase. So yeah, that's my answer for your question, Ryan.
Okay, thank you so much, Manesh and Kaza. I think in the wealth of everything that you both have said is the major causes to why prices would shift is just basically expectations and I'm looking for another word to use. I wouldn't want to use the word desire, but more or less like the very moment people no longer see possibility in what they thought was possible, they start to want to shift to a different thing. So if, for instance, people that were really interested in buying silver and then started to see the sales that happened on silver last week, their their expectation changes, their interest shifts. So they become, very what's the word? Reluctant to wanting to buy silver because now they're scared. So they would start to think more of sells than buys. So that alone shifts, the prices in the market. But not just that, also I think even global companies, banks, and all of these people as well, when events happen, they also start to shift the perception of the market and expectations. And I think it also affects one of the major reasons to why prices starts to shift in the market. So let's take, for instance, if inflation data increases, like you said, Kaza, if inflation data increases, the Federal Reserve, the central bank, starts to project what it has in plan to manage that inflation. That expectation from the Federal Reserve themselves to want to make changes starts to make the market react. So traders start to understand that there would be some changes, and everybody wants to position themselves in line with that changes. That is the main cause to why prices shift in the market. So if you're following, I hope that makes sense now. So when it comes to global events, when it comes to macro releases and all of these fundamentals, the real traders are not chasing the markets. They're actually expecting the shift. And when the shift comes in, they are positioned for it. They don't just react to the news itself. Thank you so much, Kaza.
Maybe Ryan, I can add one more piece of advice.
Yeah, please.
If you see expectation from the traders, I talk on behalf of our retail traders. When they see a lot of news that are coming from the forex factories or whatsoever forex calendar, there's one or two words that can be used. One is fear of missing out, and number two is actually greed. So just because of that, the expectation will shift immediately, right? So that's how the market works since before.
Very true.
I'd like to make one comment too.
Yeah.
Please.
So just give an example of a global event, right? And just talking high level. If the Federal Reserve increases interest rates, now what happens is people want to hold that currency. So at that point, that currency goes up, right? Demand for that currency goes up. If interest rates go down, then what happens is people don't want to hold that currency because they want to hold currencies that have a higher interest rate. So that currency goes down, goes down. So that's a direct influence of what's supposed to happen is interest rates go up, that currency goes up. Interest rates go down, that currency goes down. That's typically supposed to be the correlation there between interest rates and the demand for that currency. And that's typically what you see. That's the big, effect of the interest rate decisions on the currency demand.
But another thing as well, yeah, I also want to chip in is as much as we have like you said, the typical correlation between these things, yeah. What people also need to understand is it doesn't always work in that manner. We could see sometimes interest rate being cut, but then the currency is still strong. Because the first idea people think of is I always say these things to my students externally and internally, yeah. And I say we don't pay attention just to the currency when it comes to global events. We pay attention to the economy. Because a lot of times when you go to this news site, you see greater is better than forecast, or forecast better than previous is good for currency or is bad for currency. But in the grand scheme of things, one of the things that dictates the currency strength or weakness is the economy itself. So a lot of times what people see on macro releases are as a result of monetary policies. And monetary policies would affect directly the currency. It doesn't necessarily mean that it would always hold up the currency if the economy is bad. So interest rate could be this high, and the currency is just lagging behind it. It's just going to take, if the overall economic condition of that country is bad, and it would not really have as much effect as people think. So overall, I think when people follow macro releases, they jump into the market expecting that because it's good for the currency means overall they can stay long term in the trade. But what I really need them to understand is macro releases usually affect the currency short term. They don't shift the market dynamic overall. They could change minor structures. They could change your 4 hourly time frame structures, or they could act as propellers into ending corrections or short-term pattern corrections and all of those things. But when we look at global events and long term, we're looking large scale. We're looking at things that would shift the trajectory of the market for the next 2 quarters, for the next year, and those kind of events are the things that shift the market prices and dynamics. But short term, yeah, we could look at macro releases. We could look at immediate influx of changes in prices due to wars, people running to safe havens, and all of those things. And that's where a lot of retail traders see global events shifting prices. But for institutions, they look long term. Like Manesh will always say, institutions are not here in the market to trade your 5 minute charts with you. They have positions steady for 3, 4, 5 years, and they know their projections. Okay. So thank you guys so much for watching. If you're following and you've been enjoying the episode so far, please don't forget to hit that subscribe button to follow Valetax in and out. Make sure that you're also sharing the link to your friends to also come in and understand and have a more holistic idea of what fundamentals really look like. So now moving on to the effects, okay, Manesh and Kaza. I put here clearly, I said capital reacts before clarity. And what that statement really means is um, the money starts to move before people even start to think about what they are doing. So everyone is clicking buy and sell. No one is really starts to process how does this really affect. Take for instance, the Venezuelan invasion by US. A lot of people started saying, "Oh, oil, oil, oil," and people started trading oil ETFs and everything because they were just focused on what the rumor was, because there was rumor going in that US invaded Venezuela because of its oil reserve. And when you look at the grand scheme of things, Venezuela isn't even in the top 7 of countries with the biggest oil reserves. So what exactly so there's no grand scheme, it's just rumor. So it's why I said capital reacts before clarity. So people are always running to throw money into the market before fully understanding the gravity of that event. So I said risk moves in or out, safe haven assets strengthen, volatility expands or contracts. So we see that in gold due to, from Trump coming into office, a lot of uncertainty. Gold started to pick up. The buys on gold started to pick up prior to the US elections. The uncertainty between Kamala Harris winning and what her reforms were going to look like, and what Trump reforms were going to look like. That was where the volatility for the gold buys picked up from. And we saw that rise through Trump's what should I call it, his issues with the feds and Powell himself, and the uncertainties, the wars between Israel, Iran, Israel, Palestine, and now we see the whole Iran case as well coming up too as well. So people start to run away and try to save their money, especially countries that are in that situation. People want to put their money to safe places where after the whole event, it doesn't affect their capital and it doesn't affect their net worth overall. So things like that we see. But now the question I have for Manesh and Kaza is, if all of this really are the effects that comes with, global events, yeah, what would you say is what has been, Manesh, from your years of expertise, what would you say has been one of the major effects that you've seen global events cause? Like, has the reaction been overall from people? What's been the biggest effect you've experienced in your years of trading?
I mean, so, you have to look at the cause and effect, right? So you typically have effect, like you said, a big reaction initially where people are not thinking. That you get that because of the fear of missing out. So when you have that fear of missing out, you get a little news, people are like, oh, you know what? I need to get in right away. So you see that initial volatility reaction. And then the question comes down to is, does it follow through? If it follows through, now it could start a trend, right? And that's really what you need to look for, is the follow through, right? And the biggest global events, I think the biggest one is COVID. COVID had a big reaction into the market. A lot of people reacted right away to COVID. The global markets went down, currencies got affected, everything. So you saw that in March, one type of effect that happened. And then you saw in April, the reverse. When people started calming down everything, they saw that, things are starting to get back into control. A lot of things happened, and you saw the markets react the other way. So you have not a follow through at all from that monthly time frame, where it didn't follow through on April going down. It reversed. And at that point, the markets took off in a whole new fashion completely, when things kind of, got used to it. And that's the thing a lot of people don't understand, is that initially you get this reaction. And then if in the news, you keep on hearing about it, people's reactions become less, and they become they become passive to the news to a point they don't care about it. And that news really doesn't take into effect. And like the stuff with Iran that's going on, you had initial reaction that's going on. Now every day you're hearing about it in the news, to a point people really are becoming passive and don't care. Not saying that's right, but that's what you're seeing. And you're seeing less money flow reacting now, and less people reacting, to a point people are used to it. And, you're seeing that over and over. But I think the biggest effect was pretty much COVID. And then now Trump's second term, you start seeing gold and commodities react, as you said. That's the biggest second event I think that's happening, because you haven't seen gold and all the metals move this percentage in a short amount of time ever in history. And, you typically may see gold, which is a safety haven for a lot of global events, but you typically don't see the other commodities go along with it in that big percentage. Because this time you had silver, you had platinum, you had copper, everything that started moving at the same time at a huge percentage, which you typically don't see. So COVID and then the metal reactions, I think, are being the two biggest events I've seen, with the markets react completely. And you're starting to see more now because the internet's there. You hear news around the world more and more. Whereas, 10, 15 years ago, internet wasn't popular. Social media wasn't popular. Online brokers weren't too popular either. Now you have access to all this information in seconds, to a point people react very fast. So, in this modern age with internet, I think COVID and the metals reactions have been the biggest two events.
Mm. For some reason, I was expecting you to say the financial crisis of 2008, but you didn't say it, and now it's making me wonder why. But we'll come back to that. Let me hear from
Okay.
Kaza. Let me hear from Kaza.
Yeah, Manesh and Ryan. Actually, for me, I'm not as long as our brother, Mr. Manesh. So I started trading in 2014. My first major event that sparked me as a trader is when the Greece collapsed. If you remember, I don't remember. I think it's 2015, I guess, when the CHF dropped almost, I guess, 5,000 pips, and a lot of broker bankrupts closed, and nobody gonna pay our withdrawal, right? But I agreed with Manesh. I started trading in 2014, and one major fact that I personally experienced and I will not forget it is, of course, COVID, because it affect not only me as a trader, affect me as a citizen of a country that has a lockdown. So Malaysia have 3 years of lockdown. We cannot go out from our house. We cannot buy groceries. We have to stay at our home. So before COVID was officially treated as what we call it as a global crisis or pandemic, right? I remember market is already behaving, actually gold market behaving quite strangely. So I see the volatility started increasing and liquidity, I see it, I felt a bit thinner and a risk asset began losing momentum at that time. So most headline that are coming out at that time is still saying everything was under control. If you remember, COVID started is actually ending of 2019. That's why it's called COVID-19, right? But in Malaysia, we started calling pandemic late March 2020, I guess. So when COVID escalated, the market actually didn't collapse because the news become bad, right? It's collapsed because the capital has already started repositioning. A lot of investors already buying safe haven asset, like you said, Ryan and Manesh. People are buying gold. People are buying bond. People are buying. At the time, it's no silver. And as you said, Ryan, at the first episode, oil has plummeted to negative price at the time. You remember, right?
Yeah.
At night, I see the price of gold. The price of oil to negative 27. If I remember, I go to my petrol station to fill my car, and I see the price is still the same. You see, so so you see, so a lot of investors taking out funds at that time. They are currently beware of anything that will happen. So investors are reducing exposure, cutting risk, protecting balance sheet. A lot of business closed because of the lockdown. So by the time the fear became obvious to the public, the largest move were already in progress. Because as I said to you, investors, institution, businesses, I guess they already know it at least 2-3 months before the lockdown happened. Because I don't talk from other country. In Malaysia, we already have retrenched staff before the COVID, before the lockdown happened. A lot of factory closed, a lot of staff being retrenched from the company. When I talk retrenched, it's not from the a normal company. It's a GLC company, a government company that retrenched staff. So it's how I see COVID affect not only traders, it affects a lot of people, institution level, traders, investors, and everyone. So when I look at gold at that time, I saw a clear experience for me during that period is I didn't want to get panic because it started strengthening as uncertainty rise. So headline is too dramatic at that time. You see people dying from 100 to 1,000 to millions of people. So at that time, I fully understood that large capital is not trying to be perfectly right, it's trying to avoid being dangerously wrong. What I'm saying is the effect of every major event will not only affect the traders, it affected everyone, even a country, even a government, right? So at the end of the day, what COVID taught me as a trader is market don't wait for clarity, they respond to probability. And when uncertainty rise, capital become defensive first, explanation come later. So that experience actually changed how I trade permanently. I stopped chasing news and started respecting how the capital move under risk. If I want to chase news, Ryan and Manesh, we have news here, 11 p.m. We have the PMI, and I will stop the podcast and start trading. If I'm chasing the news now, right?
Yeah.
So yeah, that's my answer for your question, Ryan.
I absolutely love how both of you answered it. And I like how Manesh, answered from, the COVID perspective and, this whole Trump second term. Because he majorly stated the ones that he felt, shook the market. And I'm still going to text you privately, Manesh, because I want to understand why you didn't mention the 2008 financial crisis. I
You want
want to
me
know
to
why.
quickly give you an answer real fast?
Yeah, okay. Thank
Okay,
you.
so
Thank you. Give me an answer.
just in short, institutions believe in what you call market cycles or business cycles, right? So
Yep.
Yeah,
they expect things to go up and down in shifts. So when the
yeah,
internet bubble busted and technology busted in 2000, then they're looking for what's going to go up. And then we saw that a year and a half later, financials took off. When financials crashed, they expected technology to come up. So it's a yin and yang. So business institutions are expecting market cycles shifting and stuff like that when the markets go up and come down and stuff like that. So it's not something unexpected. It's expected that things are going to rotate and stuff like that. So to me, that is normal of things going up and down and balancing between the yin and yang. The unexpected events are pretty much the COVID that really shocked the markets that was not expected. And then Trump's, tenure coming in,
tariff wars.
between, what he's doing with crypto, the dollar, the global events, all those things there, which is not expected because everyone looks at what he did in his first term and thought the same would happen in the second, and it didn't. So those are the two unexpected events that happens. But the financial crisis, believe it or not, institutions knew what was going to happen. They were expecting it.
So I completely understand you now. I think I get the picture properly. Now, because of the fact that it was it wasn't an unexpected. I mean, to institutions, it wouldn't be unexpected because they understand market cycles and they know that every bubble eventually is going to get busted, so they anticipate it. But for retail traders, they would still see that as a global event. Why? Because it's not a normal knowledge. It's not an everyday knowledge for a lot of these traders. So they definitely, that's why I'm surprised now, because if you ask me to write down three global events that shifted the market, I'm definitely adding the 2008 financial crisis. And it wasn't just a United States thing or only in Asia. It was the whole world because a lot of banks closed down in my country. A lot of companies went bankrupt. A lot of foreign companies left my country. I think back then we used to have like companies like um, was I think a PNG, like PNG Unilever. They used to be very present in my country. We had banks like Oceanic Bank, Intercontinental, and all of these banks shut down due to the financial crisis of 2008. So it was a global event on the retail side. I believe institutions who were way ahead of time would have anticipated you. Probably you did anticipate it as at that time. So why it doesn't surprise you. But I know I understand why you didn't mention it. It does make sense. Yeah, thank you so much. I just wanted to add something before we move to the next thing on the agenda is Kaza, you said something about the prices of oil and you going to buy petrol in the filling station and then noticing that the prices were still the same. And I believe that a lot of what we see on the charts are really just paper pricing. They do not translate to the actual conditions happening on the outside. So it's why traders would say, "Oh, gold is the." I was telling someone, I think one of the major reasons why I kept asking if everyone is buying gold, who is selling gold, is because gold is a commodity. It's an asset. It's not just on paper. It's people buy these bars. People buy gold to make crafts, to make jewelries. We have research companies ordering golds and buying all of this thing. So do we really think that the pricing of this thing is going to be this expensive when companies are buying it, when they're using it for production? Because if the actual price of gold bars was that expensive, then we would have seen a surge in importation costs for wristwatches from, other places. But it was not mentioned. It wasn't affecting the global market. It was just on paper and pricing. Because I recently went to the market to price what an ounce of a gram of gold was. And it wasn't matching up to the pricing on the chart. And I was at that moment, I knew this was just inflation. This was typical paper inflation. People were just forcing prices up with nothing backing it. It was just fear fueled. And at the end of the day,
that's kind of why you equalize.
Exactly. At the end of the day, they set the pricing for the commodity to catch up to it, and then they make the profits. So it was just like, me thinking and rampaging my brain about it. I was like, this is not right in any way. So it's the same thing you were saying, yeah. It's how global events move. People just run capital into the market without clarity. And retail traders are always fond of following it. They always follow that trend and end up getting burned. Thank you guys so much. I really am praying that, a lot of people are watching this and they're really understanding and they always come back to these videos because these are not things that are, naturally said in the retail markets. Kaza can bear me witness to that. I wouldn't put Manesh in that equation because Manesh really doesn't have time for retail traders. He's with the big boys over there, yeah?
No. I'm a retail trader. Listen, I start off as a retail trader and always be, right?
Yeah.
I don't want to be a big boy. I'm by myself now. It's a lonely world as a retail trader, as we discussed.
Yeah. So
retail traders is the best job, Manesh.
Yes.
If you become institution trader, it's a boring job that you can do every day.
Exactly.
Because there are a lot of rules, there are a lot of do's and don'ts. But as a retail trader, you reserve that full liberty and autonomy to make your decisions by yourself.
See, Ryan, if I was an institutional trader, I would not have a smile on my face every day.
Very true. Very true. I mean, you could see traders on Wall Street. They hardly smile. They hardly give free tips. Everything is very stern to them.
They smile when they have a drink.
Yeah, when they have a cup of coffee, something to boost their adrenaline. So like sometimes when we talk about retail traders, I always talk about retail traders in the hemisphere of the regular buy and sell traders, people who aren't really foot-founded in trading. Yeah, those are like the people that most times we like to call retail traders. And truth about it is when you look at social media, they don't get this much information that we're giving out here. Everyone just teaches them how to buy and sell, how to draw trend lines, how to how to read CPI, how to read FOMC. If CPI is high, is good for currency, you trade it. But there's no in-depth knowledge really about how the financial market works. And I think the very moment as a trader you move from understanding trading into understanding the financial world itself, you gain a broader perspective of the market. You stop seeing yourself as just a buy and sell person. You start to understand yourself as an investor and actually how to make the most of trading. And I think that's the part where I'm heading to. I think Kaza is currently in the streets. He's yet to get to the house. And you have, lodged in the apartment already and, probably spent some time there already, Manesh. But hopefully we get to come and meet you soon.
Hopefully.
That is my point. So the trader's job is the next thing we want to talk about. Yeah. So people are chasing the markets, prices are shifting, structures are being, damaged and everything. But really, what is the trader's job? For me, I say the trader's job is to interpret and not react. Like Kaza would always say, he always tells his students that if you trade the market with expectations, then you're not a good trader, because the job of the trader is not to expect, it's not to predict, it's for you to speculate. It's for you to wait for prices to come and then you respond. You don't just react to the market. And then I was like understanding narrative behind the event, which is where I always try to do. When I trade live with my students and my community, I don't just give them buy and sell. A lot of times when you go online and you see people trading live, people are always joining because they want you to tell them to buy and sell. They want to click buy and sell at the very point in time. But my major focus is usually telling my community and my students that we first need to understand what the report is. Allow the market to react. Everyone is going to buy and sell immediately. Yeah, but that's not what we're here to do. We're here to understand what the macro release is. I would read it and I would translate it to you. And then we'll go and understand what time the news comes out and what session we're in. And then we correlate it together. Because I noticed something that every time there's a news by 7:30 a.m. US time, the people who react are what should I call them? Are like retail traders and all of those people, they react to the news. But the very moment the NYSE opens, we see prices go the other direction completely. So the news usually is like a liquidity trap for when the banks, the hedge funds open and they end up reversing prices in the actual direction that the market is supposed to go to. So I usually tell people, I say, if there's a news and there's a level you've been anticipating to continue a trend, when the news comes out, retail traders will push prices to that point for institutions to actually pick up the right demand to the direction of the market or the right supply. So, like I said, that's why I said interpret and don't react, because that's my number one rule when it comes to fundamentals. But what would you say is your own rule and you think is the trader's job? Kaza, what do you think is the trader's job when it comes to global events?
If you ask me, Rion, it's quite clear and it's quite simple that as a traders, their job is not to predict news or react emotionally to headline. A lot of traders, they have access to all this kind of article, forex calendars and this and that. And they always, I don't know about others, but in Malaysia, they always only reading the headline without noticing what is the article is explaining, right? I think, I don't know if in the US it will be the same things or in Nigeria, but here they always read the headline and they emotionally sees that as opportunity and they enter the market. So the trader's job is actually to interpret what has changed, right? If you understand what I mean, it's like this. With my student, what I always do when we have a major event like CPIs, NFP, FOMC, or interest rate decision, I'm not trading after the news. I'm still trading before the news. Why? Because at the end of the day, Ryan and Manesh, as I said earlier, we cannot confirm the movement of the market without
True.
seeing the true numbers, right? So as the traders, their job is to interpret what has changed, and their job is to actually what we call do a forecasting by their own based on the data that has been thrown out to them using the calendar, right? We can see the previous forecast and actual, right? And we can
Yeah.
see like 6 months of data.
Before. Yeah.
Yeah, we can see the 6 months of data, right?
They
What
don't pay
I
attention to that.
They never pay attention to that. For me, I always teach my student, if you want to read the market, if you want to learn how to trade using fundamental economy, first thing first is you need to read the numbers, right? If you
Mm-hmm.
see the pattern of the 6 month is red, or we call it a negative impact, what do you
Mm-hmm.
expect will happen for the next 3 or 6 months? That's how I'm thinking about it, because I'm a speculator. I'm not a institution trader, right? So when I see the data, I say to them, okay, for the last 6 months, I see the NFP data is increasing. Let's say we give example, right? We see the data of the NFP is increasing month to month. So what I will do is I will read a lot of articles from Bloomberg, CNN, or any other or like Wall Street Journal. I will read each and every article from this source, and I will make my prediction from that numbers,
Yeah.
because in every article they always have a numbers. Bloomberg says NFP will get 300K. BNP Paribas will say 400K. These numbers, that numbers. I will combine all numbers. I will see the what we call it, the easiest way to understand is
The
the same,
differentials.
the differential of the number, and I will take one number that has been told by so many um, article, and I will use that number as my prediction, and I will enter the market, right? Because I enter before the market happened, before the news happened. Like you, Ryan, you enter after the news, right?
The
So for
news.
me,
Yeah.
I take the risk to enter the market before the news because I read the numbers, I read the data. So that's the trader's job. They need to read everything. They need to interpret whatever numbers that come out before the news
Yeah.
happen. So when a global event happen, the most important question is not whether price will go up or down immediately. The real question is whether the event change the direction, volatility, or risk appetite. The answer to that question determine how traders should behave. Yeah, right? Fundamental do not give you entry. People always ask me, Kaza, when to buy, when to sell. I'm a fundamentalist. I call myself as a fundamentalist or economist. I don't give buy or sells, right? I don't draw trend line. I don't read the candlestick. I read the data. So I cannot give you entry buy or sells, but I can give you based on this number, this is my prediction, right? So that's how I give you the context of a trader's job. So
Yeah.
it's up to the traders to be aggressive, defensive, patient, or cautious based on the data that I've given, right? At the end of the day, you need to combine fundamental and technical analysis that will help you with timing. So, but
Yeah.
a lot of traders, they do not have that, Ryan and Manoj. They do not have the
Patience.
patience to wait. They
Yeah.
always rush in the market, even though they already know that the movement 5 to 10 minutes before the news will be so volatile. When you entry buy, you will you will lose. When you entry sell, you will lose. Why?
You lost.
Because of the volatility. So back to the topic, what is the trader's job? My answer is the trader's job is to interpret the news or the global event and see what has changed for the last 3 to 6 months and make assumption, or not assumption, assumption is not a great word, make make a forecast of what will happen for the next 3 to 6 months. So that's my answer for your question.
Okay. Okay. Basically, we're still revolving around the same point as well. It's about patience and interpretation. I'm wondering what Manesh is going to. Manesh, are we in the same line?
Yeah, but remember, I'm not a fundamental trader, so it's a different aspect, right? So my question is, the reaction you get, is it going to last or not? Right? So that's the magical question. If it lasts, then you could start a trend, and that's when I'm going to trade it and then manage that trade from a high level. So if you look at it from a technical perspective, when a news event happens, or like a report or something, then I'm going to wait for the report to happen. Then either 30 minutes later or 1 hour later, I'm going to see if it closes above the previous bar high or low. If it does, then now the event could cause a trend. If it doesn't close above the previous bar high or low, that means non-eventful, and I walk away. So if it does do that, then I look at the next bar to see if it follows through. If it follows through, I'm going to enter and then manage that trade. So when an event happens, I want to see if that reaction is really means something by, closing above the previous bar high or low. If it does, it means something. And at that point, will it follow through? If it follows through, now you can start a trend. And that's as simple as it.
I like
short and simple.
Yeah, very very short and simple. I think me and Kaza, on the point of interpretation, you are on the point of asking questions to gain clarity through charts.
Yeah.
So there's a need for the traders to actually see how the global events has happened technically, to understand if the shift that it has created in prices is good enough to shift the market structure, not just the shift in prices. Now, I have a reels that I have a reel that I made recently that would be posted hopefully this month, where I spoke about the major thing that causes a shift in price and a shift in structure. So a lot of times people don't get the difference between the shift in price and the shift in structure. Structure is when the structure itself, long term, like we're looking at the daily time frame, and structure shifts on the daily time frame. You want to know, okay, has this market moved its structure base? Have we gone from a bullish to a bearish market? Was this global event responsible for this? And now that brings me back to your question on clarity, to then ask, is this going to last? Was this just a takeout on liquidity, or is this the new trend? So it now brings them back to patience, to be able to wait and look at the charts to then decide. For people who are fundamental traders, they might be able to get an edge forward. They could have a head start because they understand the fundamentals. But if you're a technical trader, it's important for you to look at the chart and wait. Just hold your hands and just wait, just kind of relax to watch and see, okay, is the market shifting? Are we going bearish? Have we started to, someone like Manesh now, you would start to see, and we started to create, higher lows and higher highs, or are we staying back in our lower lows and lower highs kind of, event? Have we had the global event push prices to a weekly demand level or a weekly resistance level? And these are the things that becomes the trader's job. It's your responsibility to go to the charts, to actually go and check and see, okay, is this what is happening now? Have we, Manesh usually has levels on his chart, areas where he is, he's speculating prices to get to. So someone like Manesh, I believe you would go back to your charts to see, oh, this event took prices here. So it correlates. Personally, for me, I'm of the idea that how I trade sentiment and why I believe in sentiment is I use fundamentals, I use technicals, and I use conspiracies. I love conspiracies a lot because I just believe they are truths without facts to back them up. That's just why they're conspiracies. So, like my analysis on oil, Manesh, I don't know if you saw it, but let me see if I could share my screen quickly, because I know we analyzed that oil together on our first episode, and you gave me an insight to it too as well. So let's go to the weekly time frame. I think it was the weekly time, but yeah, it was on the weekly time frame where you told me if we get a full close. So we've done the buys and we've also done the sells. And if we remember, it was as a result of my sentiment looking at people trying to sell the Venezuelan oil and then the overall supply and all. So that's just the same way. It's all about interpretation and reacting. So that's why on the slide here I said fundamentals drive the market. Don't rush into a moving vehicle. That's what a lot of people do.
I remember one thing, with a fundamental trader, you're allowing more flexibility on drawdown, right? It's less about timing. Whereas from my perspective in trading, it's about timing because I'm not willing to go through the fluctuations of drawdown. I have a preset stop. And if I trade it before news and I'm not at a point where I'm profitable before news, now what happens, the volatility spikes could easily get me stopped out and then it could go in my direction. So it becomes a little dangerous in that point. So if you are going to trade from a trader's perspective before news, you have to get to a point where that position's profitable and you change your stop to where your entry is. So you go to break even before the news happens. You take the risk out of that trade completely. So, volatility spikes won't hurt you.
Yep. But the issues with certain stops during news sometimes is they don't even hold.
Yeah. But that's the danger, right?
It's like 10 seconds of the news, then everyone is losing, right? So that's how a retail trader see global event or news, Manesh and Rion, right? They always the reason why for me myself, I entered the market at least 5 to 10 minutes before the news came out is because of this. I don't hold the market. Like you, Manesh, you hold the market, right? For me, if I open one position after the news, 5 minutes, I will close. If I'm profiting. If I'm losing, I will put my stop loss at least 50% from my capital, right? So that I can cover it up after the news. So
you trade the news like me too. You have a different account where you just put in money and it's only for trading this news.
Yes.
So that way you create a risk account. So you're not trading on your main balance.
No. That's
I don't think you should ever.
that would be the stupidest thing to do if you use a
lot of people do it.
For me, I open my we call it a war trade, right? Yeah, we have my community. We have every month we will trade NFP, right? So every one day before NFP, I will tell my community to open a war trade account. It means you will put whatever amount that you want that you are ready to lose, right?
Yes.
If you're ready to lose 10,000, then you put 10,000. If you're ready to lose $5 or $10, just put $10 or $5. And then when we enter the market, if it hit the market right, you will be profiting 50%, 100%, then you close the account and you just use the money for whatever. But the main account will still remain normal. You will trade it using a discipline, lot size, risk management, and whatsoever. So that's how for us in my community or in Malaysia itself, we don't use our main account to trade news. We separately open another account just to trade the news because we want to feel the adrenaline of floating when we have news,
that's that adrenaline of volatility. That's volatility that comes into the market. It's nice. I think it's something every trader should experience at least once in their life. You need to get that high from the market where the market's just moving very fast and you're seeing the profits and the losses are going up and down. I remember when I started trading, I used to wait for NFP Fridays just because I want to see those long spiking candles and it's just red and blue, red and blue, red and blue, and you don't know where the market is going to. I think it's one of the important feelings that every trader should go through. Thank you guys so much. Thank you, Manesh. Thank you, Kaza. It's always amazing when we talk. I always learn something new from the both of you. I believe the audience still learning. If you're still watching, my name is Rion. This is Manesh, and this is Kaza. And thank you for watching thus far. Don't forget to also turn on post notifications so you're notified on when we're going to be having the next episode. And if you missed the call from the beginning and you're just tuning in, I just want to bring to you the Jacklot contest again. Manesh already registered and I know he's already trading.
I'm ready to go.
Don't forget to get registered on the Jacklot trading contest. Okay, there's 4,500 USD up for grabs right now. And every time 500 lots is traded, 1,000 USD is added to the price pool. And before we go any further, it would interest you to know that the first place is going with 30% of the price pool. Second place is going with 15%. Third place is going with 10%. So imagine what that is if by the end of this contest, this price pool is over 100,000 USD. You know what that means? That's 30,000 USD for first place with just the minimum of 100 USD is all you need to get started trading. The bigger your balance, the better for you as the trader because that gives you access to open up more lots, especially when you know what you're doing exactly and you want to win. So don't forget to join the Jacklot contest today. And don't forget to hit that subscribe button and that like button to follow ValeTalks on Facebook and on YouTube as well. So before we end the live for today, I have 3 key takeaways for us. Global events move markets by changing expectations, not just realities. Expectations is what shifts the market, not the reality of it. Realities would follow up expectations if, like Manesh said, it is being sustained. So the question is, would it last and how long is it going to last? If it does, then expectations become realities. Expectations aren't realities, so don't go chasing the market. That's why you have to wait. Capital flows determine winners and not losers. So when capital is put into the market, it is stagnant and waiting for what reality to catch up with it. When reality catches up with it, then the capital flows. It doesn't flow immediately. It is hoarded in the market to improve expectations. Number 3 is discipline matters most during high impact events. You need to be disciplined. You don't chase the market during high impact events. You wait to read, to interpret, and then you respond. And I hope this helps each and every one of us that has been on this call so far. Thank you guys so much for watching ValeTalks, and we'll see you on the next episode of ValeTalks by Valetax. And thank you guys so much again, Manesh, Kaza. I hope to see you guys on Monday, and it's always fun catching up with you. Cheers, guys.
Bye-bye.